Hi everyone, welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence. In today's video, we'll be looking at the key lessons from the legendary investor Warren Buffett in his letters to shareholders over the last 40 years. Warren needs no introduction. He's the chairman and CEO of Berkshire Hathaway, one of the largest conglomerates with businesses covering insurance, railroads, food and beverages, and even tech. This video is part of the multi-part video series we're doing on the wisdom from Warren Buffett's letters to the shareholders of Berkshire Hathaway. Today, we'll be covering two key lessons on value investing from the legend. Before we start, please smash that like button so others can find this video as well, and make sure to subscribe to receive next videos in this series on key lessons from Berkshire shareholders' letters. Now, let's dive into the two key lessons on value investing from Mr. Buffett. Number 1. Never invest just because a company looks cheap. In his 50-plus years as the CEO of Berkshire Hathaway, Buffett made several acquisitions and investments in many companies. From these acquisitions, Buffett learned a lot about when a company is actually a bargain and when it's not. In early years, there were lots of poor acquisitions that taught him these lessons. One striking example that he discusses at length in his 1979 letter is that of Wombeck Mills in Manchester, New Hampshire. Buffett decided to purchase Wombeck Mills a few years prior because the business was priced so low. In fact, the price was below the working capital of the business itself, meaning Buffett acquired very substantial amounts of machinery and real estate for less than nothing. As he wrote in 1979, it was, by all accounts, an incredible deal. But despite the appealing nature of the deal, the acquisition still turned out to be a mistake for Berkshire Hathaway. No matter how hard the company worked to turn the struggling business around, it could not get any traction. The textile industry had simply gone into a downturn. In the end, Buffett wrote in 1985, "Nothing worked, and I should be faulted for not quitting sooner." A recent Business Week article stated that 250 textile mills have closed since 1980. Their owners were not privy to any information that was unknown to me. They simply processed it more objectively. Ultimately, Buffett's distaste for cheap companies and their problems means that, while some investors argue the merits of taking large positions in companies, Buffett and Berkshire Hathaway are comfortable taking relatively small positions in more expensive firms. In 2014 letter, he wrote, "At Berkshire, we much prefer owning a non-controlling but substantial portion of a wonderful company to owning 100% of a so-so business. It's better to have a partial interest in the Hope Diamond than to own all of a rhinestone." Number 2. Never invest just because a company has high growth potential. Buffett is a godfather of value investing paradigm, buying shares of companies that are underpriced relative to their value according to some kind of analysis of company fundamentals such as dividend yield, price to earnings multiple, price to book ratio, and so on. Buffett's personal formulation of the strategy is simply finding an outstanding company at a sensible price as opposed to finding mediocre companies for cheap prices. But his embrace of value investing does not mean Buffett is skeptical of growth. It just means he avoids investing in companies solely because he thinks they have the potential to grow much larger than they are. So it's not just about growth. It's also about the quality and sustainability of that growth as part of the broader fundamentals of the company. For a long time, however, Buffett notes in his 1992 letter, investors interested in value and investors interested in growth have been considered to be at odds. Growth investors, the thinking goes, primarily look for companies that show they can grow at an above-average rate. Companies that growth investors like might look expensive today, but they are worth it if they are going to grow at or above the expected rate. Value investors, on the other hand, purportedly ignore potential growth as a function in their fundamental analysis. Buffett rejects this contrast, proudly proclaiming that growth and value investing are joined at the hip. Most analysts feel they must choose between two approaches, customarily thought to be in opposition: value and growth, he wrote in his 1992 letter. According to Buffett, we view that as fuzzy thinking, in which, it must be confessed, I myself engaged some years ago. Growth is always a component in the calculation of value, constituting a variable whose importance can range from negligible to enormous and whose impact can be negative as well as positive. Value investing for Buffett means seeking value at least sufficient to justify the amount paid. Valuing a company higher because you expect it to exhibit healthy long-term growth is not the same as investing in a company solely because you believe it will grow and then justifying your valuation. For now, that's it from us. Hope you enjoyed and learned from these lessons. Subscribe to make sure you receive the follow-up videos on key lessons from Warren Buffett. Smash that like button and thanks for watching.